The global economy is doing so-so. Middle-class salaries have stagnated for decades. Technology is disrupting so many industries that we don't even know if our jobs will exist tomorrow. The president of the USA is more focused on Twitter followers than running a country. I have all these risks in my life, the Swedish investor. How should I ever dare to bet any money in the stock market? I can't foresee the future, you know? First of all, it's not betting when you have the right tools and knowledge. Secondly, you don't have to be a fortune teller to create a fortune in the stock market. This book is a great start of your financial journey if you're new to investing, or if you have the experience but thirst for more wisdom. It will remove your fear towards the stock market and replace it with tools and knowledge, taking you one step closer of becoming truly financially unshakable. Takeaway number 1. Winter is coming. But when? Recent studies show that nearly 60% of millennials distrust the financial markets. Because of this, many of them keep 40% of their savings in cash. What's the primary reason for this? The reason is the overwhelming fear of investing at the wrong time and see your hard-earned money disappear in a market crash. I'm here to tell you that market crashes, which are called market corrections if they exceed minus 10% and bear markets if they exceed minus 20%, are nothing to be afraid of. In fact, they pose quite an opportunity. Here's the primary reason. There were 34 bear markets between 1900 and 2015. None of them lasted. The stock market has, during the last 200 years, been the best place for long-term investments. Winter is coming, but no one knows when. Some say 2019, but these same people have, wrongly, anticipated it in 2016 and 2017. Investors should focus on what they can control, not what they can't. And no matter when winter finally comes, we know that spring will follow. Here are a few facts that will keep you warm in the midst of winter. Corrections happen, on average, once every year. By knowing this, you also realize that corrections should be viewed as regular occurrences, like winter, spring, summer, and autumn. You don't fear autumn, do you? Nobody can consistently predict if the market will rise or fall. One of the best forecasters of our time is called Dr. Doom. He's famous for anticipating the 2008 market meltdown. Unfortunately, he also predicted this wrongly in 2004, 2005, 2006, and 2007. Despite many short-term setbacks, the stock market rises over time. We are not getting into economic theory here, but basically, the stock market will rise as long as there are workers becoming more and more productive, the population is growing, and technology gives us new innovations. Pessimism becomes optimism. The 12 months following the bear markets in 1949, 1957, 1962, 1970, 1974, 1982, 1987, 2001, 2002, and 2009 had an average of 39% in returns. In other words, bulls follow bears. The greatest danger is staying on the sidelines. Staying out of the stock market, even in short periods of time, can be truly costly. And alternatives don't look too great at the moment. Heck, buying a 2-year Swedish governmental bond at the moment I'm making this video provides you with a negative 0.49% in yield. That's right, minus 0.49%. Good luck becoming wealthy with that. Takeaway number 2. Don't overpay for underperformance. Quick quiz. Is your 401k, or pensionsförsäkring in Swedish, costing you money? 71% of people answer no to this question, and they're all wrong. Next question. How much does your 401k cost every year? 92% can't answer this question. I don't ask you this to put you in place. Well, perhaps a little, but primarily it's to prove an important point. People don't realize that all financial instruments come with fees. These fees are like termites, eating away all your potential capital gains. The most terrifying example is actively managed funds, which on average cost 3% yearly. Let's look at an example. Sven Svensson and Anders Andersson are 20 years of age. They each have $20,000 that they invest in the stock market. Sven picked index funds with an annual fee of 0.5%, while Anders picked actively managed funds with an annual fee of 3%. They are both smart investors, so they invest in the long run. At 55, they look at their portfolios again, as they need money for their children's college educations. Both have achieved, on average, 10% in annual returns excluding fees. Sven's portfolio is now worth around $480,000, enough to send his oldest daughter, Elsa, to Harvard. Anders' portfolio, on the other hand, is worth less than half, at $210,000. Luckily for him, tuition is free in Sweden. Now hold your horses, Swedish investor! You said that Anders invested in actively managed funds. Obviously, his yearly returns should be higher than the passively managed funds of Sven. Actually, I was being generous when I said that they achieved the same returns, as actively managed funds underperform index funds in 96% of the cases. They do, in 100% of the cases, cause you to overpay in fees though. Takeaway number 3. If it walks like an elk and talks like an elk, it's probably an elk. Or a broker. A financial advisor could be worth their value in gold. The problem is just to find a person that has your best interest in mind and is sophisticated at the same time. Advisors comes in 3 forms, and you are looking for sophisticated people from the second category. 1. Brokers. They go by many names, such as No matter which fancy title they use, you must realize that these people are salespersons under heavy pressure to generate revenues for their firms through fees. If calling themselves financial consultants helps them to reach their aggressive sales targets, so be it. If calling themselves trading wizards or elves would help, that's fine too. Therefore, their advice will often be driving fees, not growing your portfolio. 90% of the financial advisors in America belong to this category. 2. Independent advisors. Financial advisors of this category are legally obliged to act in their client's best interest. Unfortunately, these are rare birds. Only 10% of advisors fall into this category. 3. Dually registered advisors. These guys are brokers in independent advisors' clothing. They are registered as both independent advisors and brokers. In other words, sometimes they are obliged to act in your best interest and sometimes not. Unfortunately, 80% of the independent advisors belong to this group. If you've done your calculations, you now realize the hard truth. Only about 2% of the so-called financial advisors can offer you conflict-free advice. Fortunately, this still leaves us with many thousands of advisors. Here's a list of questions that you should ask to determine if the advisor is someone you can entrust your money with. I'll also put these questions in the description of the video so you can look at them later if you're interested. Takeaway number 4. Follow the core 4. Nearly all great investors are guided by 4 major principles. We are going to call them core 4. These 4 patterns can be powerful tools to increase the likelihood of you achieving your financial goals. 1. Don't lose. People in general tend to only have one thing in mind going into the stock market. How do I maximize the chances of getting a home run? The best investors, on the other hand, are obsessed with avoiding losses. It's simple mathematics. Let me ask you this. How much do you have to make to return to your starting point if your portfolio falls by 50%? That's right, you need a 100% return. This can take you many years. Warren Buffett is famous for his first 2 rules of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Margins of safety and smart asset allocation will help you to achieve this. 2. Create asymmetric risk-reward. You've probably heard that to gain more in the market, you need to take a greater risk. While I won't disagree with this, the best investors look for opportunities where this relationship is asymmetric. One way to do this is to invest in stocks during times of mass pessimism and gloom, as explained in takeaway number 1. Another way could be to invest in companies that trade below book value, buy with large margins of safety, or to use stops, but more about this on another occasion. 3. Tax efficiency. When selling stock, you realize your capital gains, and usually you need to pay tax on the profits. If you're Swedish, you might want to consider a different brokerage account other than the traditional ones, such as a kapitalförsäkring. Here, you're taxed 1% annually, rather than a normal 30% on profits. In the US, be careful when it comes to owning investments for less than a year, as they are taxed the same way as your income. If you own them for longer than a year, you will minimize the cost by usually paying 20% of profits. 4. Diversification. The author suggests that you should diversify in 4 ways. A. Across asset classes. B. Within asset classes. C. Across markets and countries. D. Across time. Takeaway number 5. The biggest threat to your financial success is your own brain. It's possible to do everything right. Invest in low-cost index funds, minimize fees and taxes, diversify over time and assets, and still end up with a mediocre or underperforming result. What's the last piece of the puzzle? Your own brain. Unfortunately, the human brain is perfectly designed for making dumb decisions in the stock market. In fact, neuroscientists have found in their studies that financial losses are processed in the same part of the brain that responds to mortal threats. Now you know why many go and hide under their bed when the market goes south. It's not enough to know what to do. You must also do what you know. Let's examine how we can execute this by looking at mistakes that your reptilian brain takes for you in the stock market. 1. It mistakes recent events for ongoing trends. Investors project out into the future what they have been most recently seeing. This is called recency bias. It's just another way of saying that recent experiences carry more weight when our brain is determining the odds of something happening in the future. This causes people to buy more when the market has been soaring and sell everything when it's been plummeting, when the rational thing to do is quite the opposite. To counter this, you should set up rules for your asset allocation. For instance, 20% capital in bonds and 80% capital in stocks. Rebalance every year, no matter how the stock market has been performing. 2. It overestimates your abilities. Are you an above average driver? An above average lover? Above average looking? If you just yelled yes 3 times towards the screen, you might be a victim of another important biases when it comes to investing. It's called overconfidence. For investors, it usually results in them believing that they can beat the market. Now, I'm not saying that this isn't possible. I'm just saying that before making such a statement, look at yourself in the mirror and ask a simple question. Why do I have an edge compared to everyone else? If your answer is, everyone else in the markets are idiots, or because I happened to stumble over this amazing stock that my cab driver recommended, you're probably fooling yourself. On the other hand, if your answer is because I spend many hours every week to improve as an investor, or because I know many CEOs that like to give me information about their publicly traded companies, you are, on the other hand, probably right. Just kidding about the insider trading, by the way. It's 100% illegal. 3. It seeks confirmation of your beliefs. This is called confirmation bias. Your mind loves proof, especially proof of how smart and right you are. This is counterproductive in investing though. What you should do instead is to seek out persons that disagree with your stock pick or people that can play devil's advocate with you. Always do this as a last step before investing. Alright, it's time to wrap it up. Takeaway number 1 is that winter will come, but so far, during the entire life of the stock market, spring has always followed. Number 2 is that you should avoid fees at all costs, especially if they cause your investments to underperform. The third advice is that a financial advisor can help you a lot on your journey towards wealth, but you need to be picky when choosing one, as they often have other priorities than your capital gains. The fourth takeaway is the core 4. Avoid losing, create an asymmetric relationship between risk and reward, take another look at your tax expenses, and diversify. Lastly, the fifth tip is that you can understand and execute takeaways 1 to 4 and still underperform in the market if you don't learn how your brain is trying to constantly fool you to make the wrong decisions about your investments. Thanks for watching! Feel free to write down suggestions if there are books on investing, personal finance, or money management that you want me to summarize. Also, don't forget to like and subscribe if you enjoy this content.